everybody, welcome back to my channel. And today we have a special video as the markets are selling off and there's volatility out there, maybe some fear sprinkled around. We're going to talk about in today's video if we are in a stock pickers market. We're going to discuss things like what is a stock pickers market? Why do people stock pick to begin with? And I'm also going to outline my favorite strategy for investing all around. Before I start, I just wanted to point out that compound interest is Bay. Love the shiny statement. So yeah, don't forget that compound interest is Bay. Okay, so let's kick this thing off with talking about what is stock picking. So stock picking, when you think about investing in general, you have active investing and then you have passive investing. Active investing is where you're actually picking stocks individually and you're trying to choose which company is going to grow and give you a return on your capital over time. So you might be individually looking at a name like Amazon or Apple or Tesla or Walmart or something, and you're thinking, oh, this is going to be a good investment over the long run. I want to own this individual stock. Now, passive investing is where you are actually investing in funds. So you are investing in ETFs or mutual funds. And I have videos where I discuss this on my YouTube channel that I'll link up the difference, between an ETF and a mutual fund, and so on. But basically, you're buying a fund where it's kind of like buying a box full of stocks. So buying a fund is like buying a box full of stocks, and you're essentially getting diversification by just owning one fund because that one fund has all these companies within it. So passive investors, typically that are buying funds, they're just chilling. They're just buying the market, indexing the market, and buying and holding. But active investors that are actually stock picking, they are doing research typically, or at least hopefully they are doing research. And they're looking at, companies' financial statements and they're trying to discern if this company is overvalued or undervalued based on different metrics. So that is essentially what stock picking is you're doing that research, you're hunting down for the next big investment, because imagine if back in the day you decided, if you were a lot younger, but when Apple and Amazon had their IPOs initially and these companies first came out on the scene, imagine if you were doing that research, seeing that vision, and deciding to invest really early on. The returns on these names have been insanely great. So these are the types of things that you can, add to your portfolio to kind of give it some extra oomph. And a lot of stock pickers are really out there in the trenches and they are always paying attention to things like company earnings and the economy and how the economic data is coming out and things like that. So that's essentially what stock picking is just picking individual stocks versus owning a fund. Now, why do people pick stocks? So people pick stocks because they want to beat the market. They want to earn returns that are above whatever the market defined by the S&P 500 or the NASDAQ or the Dow Jones or however you choose to benchmark it. Stock pickers are trying to beat whatever returns the market is giving you and get higher returns than that over time. Okay, so we all know that, most stock pickers, most hedge funds are not outperforming the broad S&P 500. There's data out there that shows this. Warren Buffett's talked about it. He says just own the index and etc. Tons of stuff out there that you can find for yourself on how people that are doing stock picking, they are typically not going to outperform the market, but some stock pickers do outperform the market. And when you average out, performance over time, remember, this isn't about, we're not thinking short term here. We're thinking about returns over time when we're managing a portfolio, and our returns over time, we want those returns as stock pickers to be higher than what the broad market defined, represented by the S&P 500 is going to show. I have found commonstock.com, and commonstock.com is a website that you can sign up and get a profile. And what you can do is you can see what other investors, other active investors that are trying to stock pick, you can see how they're actually constructing their own portfolios. You are allowed to add your portfolio if you want to actually show what you're investing in. As we're talking about this topic of stock picking, common stock is really a place for active investors to go and communicate with each other about ideas and research. So you can click on somebody's profile and you can actually see what they're investing in and if their portfolio is something more active and they're stock picking or it's something more passive. Like this person, for example, is invested in ETFs, and ETFs are going to be more of a passive, passive fund where you're investing and you're probably not doing too much trading in and out of these ETFs. It's just not the nature of those types of investment vehicles. This profile, they do have an options trade on, but they also have individual stocks in their portfolio. They're invested individually and in Tesla, PAR, Technology, C, Limited, Datadog. So this person is really doing stock picking. They are, choosing different individual names and buying those individual names. So just kind of gives you an idea of what stock picking is and how people are doing it, and how there are so many different ways to construct a portfolio. So this is pretty cool to check out. Go to shetalksfinance.com/common stock and sign up for a profile and follow me. I find that the engagement that I get is actually higher than the engagement that I get on Twitter, even though I don't have as many followers. The engagement on here is actually really cool right now, and it's a really high quality group of individuals that are in here posting content. What actually makes a stock picker's market? We know what stock picking is. It's choosing individual stocks. We know why people do it. They do it because they want to beat the market and they want to have higher returns than, the benchmark, than average, right? But what makes a stock picker's market? How do you actually know that you're in a stock picker's market? Well, 2020 and 2021, those were years where stocks were just going up. People were getting hilariously wealthy just buying stocks, and you couldn't lose because everything was just going crazy. That was a momentum market. As things were hot and bullish, you were kind of riding that momentum higher. I wouldn't quite call that a stock picker's market. So, what makes a stock picker's market? Well, in my opinion, it's going to be volatility. It's going to be things like recessions that bring that volatility. And when I'm talking about volatility, we want to look at kind of how the market has performed historically in terms of how deep drawdowns have been, how large volatility has been. So, this is actually a chart of the S&P 500, and it's showing the percentages from the highs that we've seen historically in the S&P 500. So basically the drawdowns, the corrections, the panics, and volatility is what breeds opportunity. When the stock market is just in a bull grind and it's just slowly grinding higher and higher, month after month after month, that's great for portfolio performance. We love that. We love to see our portfolio grinding higher and the value and our net worth growing. But when it comes to those times where we are in a stock picker's market where there's tons of opportunity, that's kind of where the scary stuff lies. That's where we're in those panics, we're in the trenches of hell, and we're trying to navigate what to buy and how to allocate our portfolio and rebalance things as we get this opportunity. So volatility breeds opportunity. So that's why a stock picker's market is represented by that volatility. And you can see that when we think about the big sell-offs that we've had, the big recessions that we've had, 2008, the 2008 financial crisis, we saw a very steep drawdown in the stock market, over 50%. When we talk about the 2020 panic, the pandemic panic, we saw the stock market draw down way over 20%. We saw back in 2000, the tech bubble bursting, we saw a major drawdown of over 40%. And then historically, we've seen other drawdowns as well that have been significant. So look, this is when these drawdowns happen, these deep, steep, recessionary driven drawdowns, Um, these are your times where you can build the most wealth and make the most money. And that is when it's literally the best stock pickers market you can imagine, when stocks are just falling, falling knives, and valuations are compressing. And if you assume that overall, for the future, we are going to come out of it like we typically do. Everything is cyclical, right? We've seen recessions, we've seen booms, and we've seen busts. And that is just how our economy works. Right now, we're seeing a bit of a bust, right? We're seeing things come in, we're seeing inflation, we're seeing issues, we're seeing cracks in our economy, which is leading to a lot of stocks selling off. And this is where the opportunity lies if you believe that we are not going to just fall off of the earth and die and everything is going to just end, right? If you believe that the economy will come back, if you believe that humans will prevail and business will continue to go forward and innovate and see advancements in technology, etc., if you believe that we're going to see these things and businesses will continue to be needed, then these are great investing opportunities. So stock pickers market for sure. So, another quality of a stock picker's market is stocks being at new lows, meaning new 52-week lows or new multi year lows. Sometimes when we see stocks hit new multi year lows, these can be some very great opportunities. Typically, what's happening is either the environment is shifting, the economic environment is shifting, growth is slowing because recession threats are creeping up, or maybe there was a scandal at the company. I've actually invested during scandals before. When Lululemon was having their see-through yoga pants debacle, I jumped on that and I saw that as an opportunity to purchase shares. So, sometimes if we're not necessarily in a stock picker's market, there can be individual opportunities that come in individual names that give you that stock, that ability to pick that stock up at a better price if you see future opportunity in that company. Okay, so what I wanted to do was pull up this YCharts data that I put together for you for this particular video. What I wanted to do was I wanted to represent two different market environments. One market environment was basically a momentum market, and I wouldn't call it a stock pickers market. I'd call it more a momentum market. And then the other was actually a stock pickers market, and that's now. That's what we're in right now. So on the left-hand side, I'm showing 6-month price returns from, the prior 6 months now in 2022, prior 6 months from now. And then what I did was I wanted to see what the returns were, the prior 6-month returns, what they were for that same time period. So November through May, basically for 2021. So what I did was I compared two 6-month return periods and I'm comparing them year over year. And so on the left hand side, we've got the recent returns, the 6-month price returns. And then on the right hand side, we have what the price returns, the 6-month price returns were for November through May going into 2021. So that would have been 2020 going into 2021. So you can see a huge difference between these two columns. Okay. A year ago, we had some pretty positive 6-month returns. I mean, things were really roaring, although some things like Zoom were starting to sell off and kind of come in a little bit. But if you look at things like Lucid and Align Technology, PayPal, Atlassian, Under Armour, I mean, they were having very positive returns, and there really weren't that many stocks that were too negative at that time. And then you compare that to the prior 6 months, and things look dramatically differently. I mean, just insanely differently. You can see that we're seeing some popular, really, really popular, amazing names, amazing companies that are down from their highs, or from, that are down within the 6 months, 75%, over 70%, over 60%. I mean, these are huge drawdowns for some of these companies. And what does it say? It says that a lot of these companies got very, very overvalued. If you were in the trenches during all of this, it was we talked about it a lot on the We Talk Money podcast. We tried to tell everybody, that things were overheated, things were overvalued, valuation does matter. And at that time, a lot of people were just struck with euphoria, struck with bullish euphoria, and it felt like, the market was never going to stop going up. And as we all know, that, just taking a look at drawdowns historically in the S&P 500, we all know that the stock market doesn't always go up, and it's going to hit a ceiling eventually, and it's going to have to cool back down. Well, this is happening to a very high extreme just because of how over exuberant things got. So what I just think that comparing this data side by side is very impactful, and it just shows how much right now we actually are in a stock pickers market, because these types of drawdowns, we're seeing some of these names get to multi-year low valuation multiples, multi-year low price points. We are just really seeing them come in extraordinarily and give back all of the gains that they gave before the pandemic started. So if any of these companies are actually still growing revenue, if any of these companies are actually still innovating and bringing on new technologies, acquiring other companies to grow through acquisitions, things like that, you can dive into these names individually, and there's probably going to be quite a bit of deals out there in terms of stocks that you can invest in for the long run, and individually pick them out from a list, of, I don't know, of falling knives, if you will. So a lot of these names are just great names, Etsy, Netflix, DocuSign. I mean, these names are not going anywhere anytime soon. And Zoom, Lucid, I don't know. We'll see what happens with that. I still find it hard to believe that people are spending that much money on an EV, but that's just me. PayPal Holdings, obviously PayPal's a very high quality name, and just some names here that I would love to own in my portfolio, and I'm just waiting for the right opportunity when the market kind of goes through the motions of going through this correction that it's going through right now. So this is what makes a stock pickers market. Volatility usually led by recession fears and stocks that are at new 52-week or multi-year lows. And that is exactly what people that are at common stock are trying to do. They're out there. If you think about the Wall Street Bets message boards, all of the people that got into the market in 2020, they're all out there just trying to find good investing ideas that'll help them make a lot of money over time. Because remember, a lot of people are against stock picking, but uh, there are opportunities out there where you can really take advantage of the volatility in the market, and you can really get some really good deals out there. So keep that in mind. And I want to, kind of just confirm with everybody. Yes, we are absolutely in a stock pickers market right now, in my opinion. Okay. Now, I do want to follow this up with my favorite investing strategy, because I hear a lot of people that are anti stock picking. They're anti, anything that involves not investing in a passive index fund. And I want to set the record straight for that. And I want to talk about how I, construct my investment strategy. So I obviously do not think everybody is meant to be a stock picker. I think if you want to be picking stocks in your portfolio, you need to have the time and the interest to put the work in. If you are buying stocks and you have no idea what their cash flow looks like, you have no idea what their balance sheet looks like, you have no idea what their revenue growth looks like, you're doing it wrong. You've got to get out there and you've got to do the research. And I know that a lot of people that are on common stock, they're actually putting out some really cool research, some really cool perspectives of different companies that they're looking at. So definitely check that out. But I do want to definitely make it clear that not everybody is good for stock picking. However, with that said, it doesn't have to be all or nothing. Yes, most people that are picking stocks lose money, but most people that are picking stocks are probably not taking advantage of big sell-offs. They're probably running away from sell-offs. They're running away from essentially the big corrections that are in the market right now out of fear. And to be a good stock picker, you have to run towards the fear. You have to run towards the sell-offs and the panics. And that's really hard for a lot of people to do. Okay. Now, my favorite investing strategy is combining both passive investing and active investing. I'm a firm believer in passive investing. Most of my capital is invested passively in funds, but I have an active investing portfolio, and essentially I'm utilizing what's called a core and satellite strategy. So the core of my investing portfolio is going to be my passive investing funds, and then the satellite is going to be going around it, and the satellite is going to be my stocks, my active stock portfolio, where I'm doing that stock picking. I'm going in, I'm finding the best companies. Now, do I have stocks that I pick that do not make money and they maybe become losers? Absolutely. That is the whole reason why it's so important to understand risk management and position sizing. Because what I'm doing is I'm going to be on my individual stock picks, I'm going to be sizing different stocks a certain way based on the probability that I think that the stock is going to work out over the long run, or how high quality the stock is. If I am buying a name like Apple and putting that in the portfolio with individual shares, that is a very high quality stock. I can probably afford to put more of that in the portfolio and make it a larger position versus something like, I don't know, Lucid, which is an EV. I don't invest in Lucid. I haven't ever bought Lucid shares, but just to kind of show that stark example, like, Lucid is a company that's losing money. They're trying to gain market share, very capital intensive. It's going to be a riskier bet, right? And plus they're competing against something like Tesla, which has made a name for itself. So I'm going to be positioning things differently based on the quality of the name and, basically what valuation am I buying it at? So those are just some things to consider. But I absolutely love utilizing a core and satellite strategy, and I love active investing. It's so fun. It's one of my favorite things to do, and I'm actually very lucky to be on a podcast, We Talk Money, with my co-hosts Chris Dunn and Travis DeVitt, where I actually get to talk about this stuff all the time. So if you're not following, go to wetalkmoney.com to check out the next podcast. All right, so that's everything that I had for y'all today. Don't forget to check out Common Stock. Go to shetalksfinance.com/common stock, set up your profile, and follow me, because I'm able to actually elaborate a lot more on Common Stock than I am on Twitter when it comes to stock insights and just overall market insights, economic insights. It's nice to have those extra characters to type and to actually make your point a bit clearer. And go to wetalkmoney.com to submit a question for our podcast. And I will see y'all in the next video. Don't forget, compound interest is bae.